Good evening, Ken Long from Tortoise Capital Management, September 2nd, 2009, with the market health check, daily summary, daily tactical, and some look at some 5-day down setups and the overreaction system signals. To begin with the market health check, what we've got now is the fourth day in a row of selling, a very tight doji range. We can see volatility is in the bull normal range. ADX has rolled down from above 35 down to about 30. Plus DI has just about met up with minus DI, so what we've got really is a market that was trending strongly up and is now reverting back towards sideways. We still have support at 100, where it's resting right now, and next support at 98, and then about 97 with the 50-day moving average. After 97, it's Katie bar the door to the downside. On Williams percent R10, we've moved in 4 days from overbought to oversold. MACD histogram is below the signal line now, so we're on the right side of value, but we can see that already from Williams percent R. And the last time we've seen Williams percent R, we've seen here some nice moves up, and here nice powerful move up and kept going. Here, nice move up and kept going. So we're always interested in a bull market when Williams percent R10 is below 80. We have the possibility for market melt-ups. When you see the SPY look like that, a pullback of that much, it's not unusual to find some excellent setups in the 5-day down, and in fact, we have a bunch of them. This would be a good place to stop the tape to take a look at S&P 100 setups that meet the 5-day down criteria. They're all 5-day down. You can see many of them have Williams percent R10 of under 80. So what we're looking at here really is a symptom of, or a consequence of, the market condition broadly. And so these, I don't consider these to be really individual signals, but really they're part of the overall market condition. And now here's a look at ETFs from around the world that meet those criteria as well. You may want to stop the tape there too. But a ton of really good setups. The key tomorrow will be to watch what SPY does. If we see SPY revert to the mean and start going back up, it could be an extraordinarily powerful melt-up day. You can see by the size of some of the white candles on these ETFs just why we care about those melt-up days, because you can make really good risk-adjusted returns on that kind of a day. Okay, quick look now at the daily summary. We're in bull normal, 10-day index, we're oversold. You can see we're oversold here. These 10-day max pain candidates are going to be on the short list for tomorrow. We can see the pivot point is at 98 and .84. We've got a ton of very good setups in the overreaction system, a ton in the channeling system, and again, these are reflections of market conditions broadly. These are not individual signals when you have that many of them all happen at the same time. This is saying something fundamental about the market. We've seen the weakness of the last week to 10 days reflected in the slope of the 30-day regression line declining. Volatility, you can see here, has just peaked above the red line, so that puts us into normal conditions. The convergence of plus DI and minus DI, so there's no real difference between those two lines as the market proceeds to lose steam. These are the high priority 5-day down setups in the ETFs and in the S&P 100 large caps. A ton of very good setups also in the triple screen system. These are all very powerful moves that have pulled back below the 20-day moving average. There's some goodies in there. On the daily tactical, you can see in the Dow 30, sorted by the 10-day index, the ones that are dramatically oversold. And I like CAT, Procter & Gamble, JP Morgan especially. You see the red ticker, that means it was a big loser today. And you can see all of that was lost on the 3-day, over the last 3 days, this painful move. The green tickers are all ones that would be candidates for follow through tomorrow if there's strength. So if you believe in second day momentum, Coca-Cola would definitely be high on the list because it turned in a plus 2.62% day today and closed right near a key price level of 50. If it breaks through 50, there's no resistance overhead, and it can get to 54 over the next month or so without straining the bounds of believability. Over on the ETF side, you can see that a lot of red signals are flashing now that many, if not most, of the world markets ETFs are now on short-term oversold. Gold and silver were the big winners today. Treasuries have been doing fairly well. Natural gas and the commodity areas are still suffering. I want to take a look now at the overreaction system signals because that's so high reliability and the follow-through is so powerful. This is a candidate for being a turbo. So what we're looking at generally is yesterday's price action, defining that as the yellow zone. Now in the overreaction system, we mechanically buy the entry tomorrow no matter what. And we just take what we get until it crosses back over this blue line, the 10-day moving average. But to engineer the entry a little stronger, to get a better position size and manage risk, we're going to look to see where price opens and then see if we can frame a very tight trade. So green, it would be anything where we definitely want to be long, and that's where it's a penny or a nickel above yesterday's high. The red zone would be places where we want to be short, and that would be a nickel below yesterday's low. And because it's a nice tight doji, that's good because we're going to get a directional move tomorrow, one way or the other, and it's probably going to be strong. So this is the day that the signal fired to the right of the blue line. So that's what we have there. You can see the investable edge is going from today back up to a retest above the 10-day moving average. So if we frame this in the usual way, I would see something like this. That's our potential. We're looking to mechanically frame this. I'd be looking for a profit target around 97 with an entry a nickel above. It's right about 93. We're at the edge of the green zone, and then with a stop loss right on the edge, right on the boundary of red, as you can see at about 92.7. And that's the frame on DIA, the Dow. Same idea in ILF. This is the day we're interested. I sort of like ILF already. This was a big up day for ILF because of the news of the oil find by British Petroleum, and then Petrobras has a piece of that also in the Gulf of Mexico. So we're looking at a retest of 41 potentially on the normal trade frame. And that would be our box, our stop right in here, nickel below, mechanical entry here. I think if we saw it gap down and then start going up with strength and SPY was strong, we wouldn't have to wait for 38. And we'd be looking at trying to work it all the way up to 41. Now, the same idea framed on a smaller basis. We already have seen ILF. This is what it looks like on a little bit of a smaller scale. Here's SPY, the same deal. You can see all of these are reflecting basically the same pattern because they're all correlated so strongly with SPY, and that's why we would watch it tomorrow. Small caps and Russells, all very attractive as a trading vehicle because they're so darn volatile. 4 times as volatile as the NASDAQ 100 right now. So that's a quick look at the daily tactical and this daily summary and the market health check and these high priority overreaction signals. Good trading tomorrow. Be ready and for market melt up potential. And good evening.